Welcome to Chapter 20. Welcome to Chapter 22 of the Canadian Securities Course, Volume 2. In this chapter, we are going to be discussing other managed products. So I do have a list of 5 different other managed products here. First off, we have segregated funds. Second is the labor-sponsored venture capital corporations, or LSVCC. We also have closed-end funds, income trusts, and the listed private equities. So we're going to go into each of these 5 managed products specifically, and we're going to start off with segregated funds. So segregated funds, they are a type of pooled investment much like a mutual fund, but they are considered an insurance product. Now they offer the same features as mutual funds along with a few extra benefits including maturity protection, death benefits, and creditor protection. So regulation of segregated funds. So this is something that is quite important to understand. So segregated funds, they are regulated by the Canadian Life and Health Insurance Association, Inc., and each province and territory has accepted this entity's guidelines as the primary regulatory requirement. Now, the Office of the Superintendent of Financial Institutions are also responsible for ensuring that federally regulated insurance companies are adequately capitalized under the requirement of the Federal Insurance Companies Act. And also there is Assurus, and Assurus is the insurance industry's self-financing provider of protection against the loss of policy benefits in the event of the insolvency of a member company. So only if a company becomes insolvent and you can't get your money because of that, that's the only time Assurus will be useful. And the Assurus guarantee covers only the death benefits and the maturity guarantees. So the maximum compensation that can be awarded under an individual segregated fund policy is $60,000 or 85% of the promised guaranteed amount. So that's the only sort of guarantee that this company can offer if a member becomes insolvent. Now, there is a specific structure for segregated funds. So investors, they are assigned notional units of the contract. That's an important distinction for segregated funds. And they do that because if you own shares of a mutual fund, it actually, it basically means you'll own ownership. Whereas if you are assigned notional units, it's not really ownership, and they don't really want that because it's under an insurance type policy. So with segregated funds, you do have the contract holder, the annuitant, and the beneficiary. So the contract holder, it is the person who buys the segregated fund, and it can be held in a registered plan, so RRSP, RESP, RIF, or a TFSA. And when the contract is held outside of a registered plan, the contract holder can be someone other than the annuitant. So that's only when it's held outside a registered plan, then this contract holder can be someone besides the annuitant. And the annuitant is the person whose life is insured. So if you're purchasing a segregated fund for someone else, and they're the beneficiary, it must be held outside of a registered plan. And the annuitant, it is the person whose life is insured by the contract and on whose life the insurance benefits are based on. And the contract holder, they must have an insurable interest in the life or health of the annuitant. So it can't be just some random person on the street. And basically, the proposed annuitant must consent in writing to have his or her life insured as well. Now, the beneficiary, it is the person or persons who will receive the benefits payable under the contract upon the death of the annuitant, and you can designate more than one beneficiary, or you can also designate the estate. So now we're going to go into some features of segregated funds. First off, you have the maturity guarantees, and it is a promise to the contract holder or the beneficiary that they will receive at least partial guarantee of the money invested. Now, maturity guarantees, they must be at least 75% of the amount invested over a contract term of at least 10 years. And then 100% guaranteed funds are often longer term, like 15 years or so. Now, because you are given this maturity guarantee, they do feature higher MERs. And if you get the 100% guaranteed funds, they have even higher MERs than the 75% guaranteed funds. And do keep in mind, you can only basically use this maturity guarantee if your segregated fund is lower than what you purchased it, either 10 or 15 years after you purchased it. This basically never happens because, of course, the market will be increasing if you purchase it 10 years ago. The odds of it being lower is really low, especially if you're in something balanced or something even in equity. Now, there are some age restrictions to segregated funds. So insurance companies offering 10-year maturity guarantees that exceed the statutory requirement of 75% may impose restrictions on who qualifies for the enhanced guarantee. So, for example, the person with the death benefit may be based on the person being no older than 80. So you can't just choose someone that's really old and has a high potential to die in the coming years to be the beneficiary or be the annuitant on here, so you can just claim that death benefit. Now, reset dates. So segregated funds, they may be renewable when the term expires, depending on the annuitant's age. And a reset date allows the contract holders to lock in the current market value of the fund and set a new 10-year maturity date. So that can be somewhat useful. So if your fund, let's say, started at $100,000 and it went up to $150,000 10 years later, you can reset that or lock it in. So then your maturity date counts for the 150. So let's say it dropped by 10,000 to 140,000. 10 years later, you can sort of use that maturity guarantee and bump it back up to 150. Now, some other features of segregated funds include the death benefit. So the death benefit is a guaranteed amount that you will obtain if the annuitant dies. Now, you only actually get this if the market value at death is below the guaranteed amount. So let's say you purchased a segregated fund for $10,000 and the market value dropped to $8,000 and your annuitant died, then you will get a death benefit of $2,000. So the total amount paid to the beneficiary would be that $10,000, which is your guaranteed amount or the amount you started at. If you happen to see any growth on your segregated fund and the annuitant died, then you wouldn't actually get a death benefit. So it is only helpful if your segregated fund decreases in value while the annuitant dies. Now, you also do have creditor protection. That's another feature of segregated funds. And they are unique among managed products since they do offer this. So creditor protection, it is available because it is owned by an insurance company and rather than the contract holder owning it. And it can be helpful for circumstances that make them vulnerable to court-ordered seizure of assets to recover debt. And it's also helpful for people with personal liability or someone that owns a company or something like that and has that liability. Now, there are some other features to segregated funds. You have bypassing protection, and this avoids the probate fee when for the estate when the annuitant dies. Segregated fund contracts are not regarded as part of the deceased's estate. So the proceeds of the fund pass directly into the hands of the beneficiary. It does save on fees for lawyers, executors, etc., but it doesn't save on the taxes. There is a cost of the guarantees. So segregated funds, they have the same fees as mutual funds, along with some added costs, so you can have these benefits. So the MER on segregated funds are always higher than mutual funds. You also do have bankruptcy and family law. So under the federal bankruptcy law, segregated funds are not normally included in the property divided among creditors if it can be proven that the purchase was made a year or so before the bankruptcy. And taxation on segregated funds. So it is a bit complex since you do have all these different guarantees and death benefits. But basically, with the tax on the guaranteed maturity, the payments from a segregated fund contract, maturity guarantees, they are taxable. So if the proceeds are less than the ACB, then the income tax is payable on that guaranteed amount if you look to reset it after that period of time. So that is a taxable amount. As for the death benefits, when the annuitant dies, the contract is terminated and the beneficiaries receive the market value of the segregated fund, which will include that death benefit. So it will go back to whatever you purchased it for, basically. So this will be tax-free. Now, if the contract holder is not the same as the annuitant, the contract is taxed as capital gains. So do keep that in mind. There is a slight difference there. If you are holding the contract and you're not the annuitant, the contract or the death benefit is capital gains. Now we're going to look at labor-sponsored venture capital corporations. So these are managed investment funds sponsored by labor organizations to provide capital for small to medium-sized emerging companies. It was used a lot back in the day, but isn't really used as much now. It does have some pros, so they do offer federal tax credits, 15% federal and provincial tax credits on annual investments, and you do have a max of $5,000 invested. And you can buy them within an RRSP to offer further tax savings. So they do receive that RRSP tax deduction, and you can also receive the LSVCC tax credits. Now, some cons are because of the nature of the company in which they invest, they're considered high-risk speculative investments. So they're suitable only for investors with high-risk tolerance. And often you will see that these will decrease to zero in value. They're that speculative. And the Income Tax Act requires that shares be held for 8 years to avoid the recapture of federal tax credits. So you do need to hold it for a long period of time, which could cause it to decrease to zero. So you might not actually get your money back or the money you invested back, but they do offer those tax credits. Now, closed-end funds, so they are pooled investment funds that initially raise capital by selling a limited or fixed number of shares to investors. And the structure of closed-end funds, so they're listed on stock exchange. Underlying assets in the closed-end funds are preferred shares, diversified holdings of a basket of foreign-based manufacturing companies, REITs, etc. So the advantages of closed-end funds is that the diversification can reduce the risk, and a portfolio of closed-end funds that have a low degree of correlation will sort of smooth out that adverse effect of closed-end discounts. They do offer short selling, and it is more fully invested, unlike an open-end fund. And you will get capital gains, dividends, and interest that are paid directly to the investor rather than reinvested in additional units like mutual funds. That is sort of a disadvantage as well, since you can't automatically reinvest those dividends. Also, the closed-end funds, they do not necessarily trade at the net asset value per share. So in bear markets, as the value of the underlying asset declines, the gap between the discount and the net asset value does widen. And income from funds sold on foreign exchanges, they are considered foreign income, so that's another disadvantage from them. You also do have income trusts. So an income trust, it is similar to a closed-end fund, but investors purchase ownership interest in the trust, which in turn holds interests in the operating assets of a company, and they are traded on the TSX. So there are two categories of income trusts. You have the real estate investment trusts, or REITs, that purchase real estate properties, and they pass the rental incomes through to the investors. You also do have business trusts, and these purchase the assets of underlying companies, usually in manufacturing, retail, or service industries. Now, there is also listed private equity. So this is another managed product. So private equity, it is the financing of firms unwilling or unable to find capital using public means through the stock market or bond markets. And the long-term returns of private equity typically exceed most other asset classes, but they are exposed to far higher risk. Now, the methods to provide finance to firms, they include leveraged buyouts. So this is the acquisition of companies financed with equity and debt. There's also growth capital. This is financing of expanding firms for their high growth rates. There's turnaround investments, provide financing to underperforming or out of favor industries. You also have early stage venture capital. This is when you invest in firms that are in the infancy stages of developing products or services in high growth industries, as well as late stage venture capitals, where you look to invest in more established firms. There's also distressed debt, a lot like the distressed securities strategy, which we looked at previously. This is the purchase of debt securities of private or public companies that are trading below par. And then finally, you have mezzanine financing. So this is financing through floating high yield unsecured preferred equity or subordinate loans. Now, listed private equity does have some advantages and disadvantages. It does have access to legitimate inside information and influence over management and flexibility of implementation. So you sort of do have a bit of control over the private company by investing in them. The disadvantage is that it is an illiquid investment. It's quite difficult to sell your portion of that private company, and it does depend on key personnel, because often these private companies, they aren't very large. You're really depending on one or two key people in that business. And so anyway, that is everything from this chapter of the Canadian Securities course. Again, stay tuned for the next chapter.